Hey everybody, welcome back to the Mighty Indexers channel, and in today's video we will be taking a look at Constellation Brands. Constellation Brands is an American producer and marketer of beer, wine, and spirits. It is also a Fortune 500 company, and it is the largest beer import company in the US, measured by sales. This company is on a massive downtrend over the last 5 years, which has been making a lot of YouTubers post about it, saying it could be quite an opportunity, also because the PE ratio is low and their dividend is 3%. Taking a look at Constellation Brands over here on a deeper dive, we can see that they recently plummeted 6% because of a major shareholder exit and muted forward guidance. Muted forward guidance is not a good thing when it comes to, sales and projecting forward PE ratios, right? Because that could make the forward PE ratio higher, or it could make it the same, meaning that they're not growing. Taking a look, same 5-year chart, hitting the max button, we can see it's been on a rip up until around 2018 to around 2023. About 5 years right there, it only grew about 15%, and then it's been on a steady downtrend since 2023 to 2026. 3 years of falling in half. Now, when we take a look at Constellation Brands' financials, we can see that the revenue for the past few years has barely went up. So when you see that in a company, it tells you that their revenue is not growing. It's actually going a little bit further down, because you can see in 2022, 8.8, 2023 to 2025, the revenue did increase, but in 2026, it started going back down. Their net income is kind of all over the place. So negative 40 million, negative 71 million, positive 1.7 billion, negative 81 million, positive 1.69 billion. Now, the market likes to see steady numbers, right? So when it sees numbers like this, it can cause a company stock to tank, because net income is the bottom line. Now, your earnings per share is sitting at around $10 to $11, which, it's steady. It's not decreasing. It's higher than it was back in 2022. Taking a look at the 10-year chart, Constellation Brands is down 20%. And when we head over here to earnings, Seeking Alpha likes to give a projection, right? So we can see that their earnings is supposed to supposedly hit 12.39. These are estimates, right? So revenue is supposed to hit 9.2, estimates again, which leads to a lower forward PE. Now, this is assuming everything goes right. Something happens, if there's a stutter in sales, this could easily be a forward PE ratio of 22 and a forward PE ratio of 21. This is a magnificent ETF, the State Street SPDR Portfolio S&P 500 Growth ETF, ticker symbol SPYG. So SPY is the S&P 500 ETF, SPYG is the S&P 500 Growth ETF. And on the last 5 years, it is up 81.7%. Years, it is up a whopping 357%. Versus Constellation Brands, which is down 20%. So you got down 20% for 10 years versus up 357% for 10 years. That's this ETF right here. And this ETF, the way it works is they basically select, they're using the S&P 500 Growth Index, selecting large cap companies from the S&P 500. So it scores it using growth factors like sales growth, earnings change to price ratio, 12-month price momentum, and it basically market cap weights them. It holds around 150 to 200 stocks, with a heavy concentration in obviously technology, because those are the largest growing fastest growing companies. Fun fact, Constellation Brands is a holding of this ETF. It's a small holding of this ETF, but it's in there. It's 0.03%. So the whole point of an ETF like this is to mitigate risk from companies like this, Constellation Brands. They have a lot of different brands. They generate a lot of different sales from these brands. And there is a multitude of YouTubers who will be pushing this company, loading up, fair value, buy now, a deep discount to fair value, a stock update. Notice none of these YouTubers will tell you to buy a good growth ETF. They're just telling you about this one individual company that has been going down the last 10 years, 20% negative, versus a good growth ETF that is up 357%. And the reason for that is because they will not get the views, 14K views, 2K views. It's all about the views, guys. They don't care about your portfolio, right? Nike, decade low. But look, they don't show you that Nike is underperforming the S&P 500. So when you look at YouTube and you compare individual companies, you have to be smart. You have to educate yourself on ETFs, which have plenty of different holdings. This has 149 holdings, and it has a little bit of everything in there. And you would make more money with an easier ride versus something like this, where, now people are telling you, look, it's so undervalued, but they're not showing you pretty much anything. They're not showing you that it's been down the last 10 years versus this ETF that's up 357%. Anyways, I hope you guys got the point of this video. If you liked it, leave a comment. Hope this helped somebody out for sure. And if you guys want to see a different company featured on the channel, let me know.